Welcome back to our class. In our last video, we have discussed spin-offs and split-offs. Both of them allow a subsidiary to be completely separated from its parent company. Spin-offs and split-offs generally are expected to bring positive impact on shareholder wealth because they allow the parent company to focus on its core business. Besides, a separate listing of the subsidiary may help investors to better value the subsidiary. Sometimes, a parent company may want a separate listing of its subsidiary, but at the same time may still want to retain some ownership or even control rights in the subsidiary. An equity carve-out can fulfill this need. In this video, we will be focusing on equity carve-out. By definition, an equity carve-out is a partial IPO of the stocks in the subsidiary. After IPO, the parent company would often retain a controlling interest in the new public company. Equity carve-outs are different from spin-offs and split-offs in several aspects. For example, spin-offs and split-offs have no tax consequences, but equity carve-outs may trigger taxation for the parent company. The shares issued in an equity carve-out may be newly created when there is a primary offering or come from the parent company when there is a secondary offering. A primary offering and a secondary offering have different tax consequences on the parent. While primary offering has no tax consequences, a secondary offering can result in capital gains to the parent company, and capital gains are taxable at corporate tax rate. Another difference between spin-offs and equity carve-outs is that in spin-offs, the ownership structure of the parent and the subsidiary is the same, but equity carve-outs would result in a set of new shareholders in the subsidiary. Next, equity carve-outs also bring in cash flow for the parent company when its shares of the subsidiary are sold. But spin-offs and split-offs do not create any proceeds for the parent. Academic studies on equity carve-out generally find a positive announcement effect for the parent company, which means the share price of the parent company tends to outperform the market upon release of equity carve-out announcements. But in what ways could a company benefit from equity carve-outs? The first reason is that the parent company, who does not manage a subsidiary well, can convert its assets into cash and may invest in more productive areas. Secondly, a separate listing of the subsidiary allows for better and more defined information disclosure about both the parent and the subsidiary. Thirdly, divisions may be consolidated into a more efficient form, and managers may work with new compensation incentives. Equity carve-outs bring new capital to the parent company, but a company wish to bring in new capital may also have a follow-on offering of its own equity. However, equity carve-out and follow-on equity offering have different impact on share price. While equity carve-outs are generally shown to positively influence shareholder wealth, follow-on offerings, however, are generally shown to negatively influence share price. The first reason is that a follow-on offering is dilutive. Next, companies tend to issue additional shares when the price of their stock is relatively high. So, follow-on offerings may signal the current market price is overvalued. A study by Shipper and Smith in 1986 found that shareholders of the parent firms experienced average gains of 1.8% following equity carve-out announcement, while firms engaged in seeded public offerings of common stocks experienced an average of 23% shareholder loss. An example of equity carve-out is the separation of Lehman Brothers from American Express. Lehman Brothers used to be housed within American Express under the name Shearson Lehman Brothers. While Shearson Lehman is an investment bank, American Express' core business is credit card operations. Investment banking business is considered more risky than credit card service. American Express decided to limit its exposure to the more risky investment banking industry. In 1987, American Express carved out 39% of Shearson Lehman Brothers. In year 1994, American Express further spun off its remaining shares of Shearson Lehman Brothers, and Shearson was dropped out of the name afterwards. The investment banking industry underwent a drastic change in the last subprime crisis, and Lehman Brothers filed for bankruptcy in year 2008. Okay, in this video, we have introduced equity carve-outs and have made comparisons among spin-offs, split-offs, and follow-on offerings. Thanks for watching. In the next video, we will introduce split-ups.